There's been just one detached closing on and off market in Bird Rock, La Jolla's $9 to $11 million range over the last 2.5 years, ever since January 1st, 2024. By contrast, La Jolla overall has seen 20 closings within that same time frame and price band, including the one in Bird Rock. And here's where it gets interesting. The Bird Rock trade was a $10 million closing from January 2025, and it was the only waterfront property out of all 20 closings. So if you remember from my 7 to 9 mil range analysis, we uncovered that Bird Rock is the primary gateway to waterfront in the 7-figure range. Well, now we're seeing that pattern continue into the entry point of the 8-figure range as well. So Bird Rock is providing waterfront access in this price band. It's not providing volume. Now, this $10 million Bird Rock trade is on Calumet Avenue's southernmost tip, right off Sea Ridge. It appears to have been a major remodel completed in 2017 with design by locally renowned architects Will and Foch and construction by Tom Waters Construction. The home rests on nearly a quarter acre and includes roughly 113 feet of ocean frontage with views all the way down to Pacific Beach, Point Loma, and beyond. An oceanfront pool and spa, a primary suite that makes up the entire second floor plus more. It went pending after just 104 days on market, or just over 3 months, and sold roughly 13% below the initial list price of $11.5 million. The seller did not need to make any price adjustments in order to go pending either. This home also sits on the smallest lot size within the lot range of these 20 closings at 0.22 acres. The square footage was the second smallest at nearly 3,900 square feet. And then the price per square footage was nearly $2,600 a foot, which is the second highest. So that makes sense because, as we know, the closer you are towards the water, the smaller the home footprints tend to be on average. Now, let's zoom out and take a closer look at the full group of 20 on and off market closings within La Jolla's $9 to $11 million range within our analysis here. So, the $9 million range is leading with 13 trades. The $10 million range has 5, and then we have 2 at $11 million on the dot. So we also did have Dr. Seuss's former residence, which I'm sure you heard of, on Encilia Drive in the Country Club, which just closed for $9 million on May 29th. However, for consistency with my tracking methodology, that one technically belongs in the 7 to 9 mil range analysis. So the leading neighborhoods so far are Meerlands in first place with 7 trades, not surprising. Second place is La Jolla Shores with 5, and then we have the Country Club in third with 3. What's interesting is that this mirrors a similar pattern from my earlier 7 to 9 mil range analysis if you saw that video. Meerlands was essentially leading, the Shores was in second, and the Country Club was in third. So these are not one-off neighborhoods. These are clearly the most active neighborhoods across multiple upper-tier price bands. Now, looking at the yearly $9 to $11 million range breakdown, 2024 had 6 trades. 2025, there was a surge with 12. 2026 so far this year, we have 2, both of which are in Meerlands. So from this year, the first one to discuss is going to be a $9.5 million closing on La Jolla Scenic Drive South. So that one sold 282 days from the initial active date, so just over 9 months. They did 2 reductions and ended up selling roughly 17.4% below the initial list price of $11.5 million. The second one is going to be on Solimar Drive. So that one closed for nearly $9.3 million, and it took 123 days to go pending, so just about 4 months. And that one, they did 1 reduction and ended up selling roughly 5.8% below the initial list price of $9.85 million. And as of today, there are none pending on market likely to close within the $9 to $11 million range. So you might be asking, why did we see such a surge in trades last year in 2025, and then this year so far we have 2? Well, if we look at the same point that we are today, June 18th, last year, we had 6 trades already, both on and off market. So those were Calumet Avenue in Bird Rock, $10 million. Meerlands Vista Way in Meerlands, $10.7 million. We had Solimar in Meerlands, $10.5 million. That was off market. Whale Watch Way in La Jolla Shores, $10.2 million off market. Calle de la Garza in La Jolla Shores, $9.15 million. And then we had Camino de la Costa, which is in Lower Hermosa, Hermosa Terrace, $11 million that was off market. And the 2 closings from this year were both on market. So we may be behind 4 trades in comparison to last year. However, the tax records do lag roughly 2 weeks, so there may be some off-market closings that have not reflected yet. So let's see how the rest of the year plays out. Now, let's take a look at the active inventory levels year to year. And yes, I do have it documented from last year. I'm using a slightly wider range for the active inventory from $8.9 million up to $11.9 million because homes listed slightly above or below may be part of the same buyer choice set, and list price does not always equal the sale price. So the earliest date I have recorded is February 23rd, 2025. And as you can see on this chart, earlier in 2025, there were not many options available for the buyers. There was about 0 to 2 homes available at a time. Inventory did not start picking up until sometime in May, where on May 12th, I have 4 active detached homes on market recorded, and on May 29th, there were 6, okay? So that means that the sellers had either reduced into range or they came onto market during that time. Now, let's compare this to when the 2025 sold homes went pending, okay? So again, last year, 2025, we had 12 sales, but 9 of them were on market. On this chart, you can see when those 9 closings went pending, okay? And clearly, there's a huge gap between February through May, because those were the exact dates or exact time that I showed you there was no active inventory. There were limited options, right? So clearly the buyers were not biting when there was limited inventory. It took about a month for them to respond after the inventory shot up, right? Because then you can see it started picking up again in June when Idle Hour and La Jolla Farms went pending about a month after their second reduction. And then from there, you can see one home that sold within the $9 to $11 million range went pending per month, except in November. So clearly last year, they started with limited options, but they needed more options available for the buyers in order to unlock activity. Now, on this chart, I've added the active number of homes available on market this year, except for it's the same exact dates as last year, okay? So for example, look at February 23rd, last year versus this year. Last year, we had only 1 option available on market within range. But this year, there was 7. That's a major difference. It's the complete opposite, right? So that means the buyers this year, they did not start with the same drought that they had last year. So with last year, you might be thinking, okay, well, it was a scarce environment in the beginning of the year. I mean, isn't scarcity power? Doesn't that mean that, buyers are going to bite? No, not necessarily in the high end, because the higher end does operate differently than the lower tier ranges, right? Because someone who is purchasing a property at this caliber, they may not necessarily have to move 9 times out of 10, right? Of course, there's outliers, but they may not necessarily have to move. They may have the luxury of just waiting until the right home comes along. And then if the right home doesn't come along, they're going to wait, or they might go find something off market, right? So now, where we are is, again, it's the complete opposite. So that means that we have an abundance of availability. So we've moved into comparison pressure. So that means that the buyers now have an abundance of options and they're comparing all of them. So it's almost like the paradox of choice. There's a lot of options for them now, except for today, there's 4 available on market. So not 7, but still. Just look at the beginning of the year and how it started. So that also may be part of the reason why we are behind. I'm not saying it is for sure, but I'm just saying like the start of this year was the complete inverse of last year, okay? And what we know is that the sellers are competing for the next serious buyer, because last year, the pending pattern that we saw from the other chart, you saw that there was about 1 going pending per month after June, pretty much. So that means that the sellers now, like, they're competing for the next serious buyer. That doesn't mean that everyone gets chosen at once, right? Now, out of the 20 total closings within our analysis here, 15 of them sold on market. So let's take a closer look at the days to pending versus the percentage sold off the initial list prices, because the pattern is quite linear. And please note, 2 of these properties did not have their pending dates inputted into the MLS, so their sold dates were used as the best available timing reference. The first thing I'd like you to notice is that every single one, all 15 of them, sold below their initial list prices. Now, let's take a look at the ones that moved the fastest. That means pending, or in one case sold. That's anywhere from 5 to 63 days. They took the lowest percentage discount off their initial list price, anywhere from 0.21 up to about 2.7% off. and with no need for reductions for all three of them. Now look at the bottom of this chart, the homes that took the longest, anywhere from 670 to 1105 days to go pending under contract. So those ones, that means that they were sitting for about 2 to 3 years to sell, 2 to 3 years. They took the largest percentage discounts off their initial list prices, anywhere from about 34 to 37% off. So about, let's say, just over a third. And they had the most amount of reductions concentrated there. Do you see that? So that's why this is so important to show you, because I would like you to understand that when you overshoot the price so much, you know, there can be consequences. Of course, outliers exist. I'm not saying they don't, but I'm just saying the chart is quite linear. So if you're a seller and you've been trying to sell for, let's say, 2 to 3 years, even if you take a few months off selling, there's a high probability you may sell about a third off your initial list price. So that is just a seller warning. As a seller interviewing agents, it can be tempting to choose the person who gives you the highest number, especially if they have strong marketing, a big name, or a high-end brand behind them. But the truth is that the market responds to price, product, and presentation. So if you have an agent telling you they can help you achieve a number for your property that is higher, primarily because of their marketing or their reputation, well, an important question to ask is, then how come there's a clear pattern of the aspirational pricing not working based off of the evidence provided, even when those listings had the best marketing sources backing up the prices? Why wasn't it working then? Because when a property sits, reduces, and sits again for time over time and starts collecting a long history, the leverage begins to shift and it's not in favor of the sellers, and the proof is in the numbers. The buyers, they start waiting and they start watching. So eventually that means that the seller is not just negotiating off the latest list price that they have, they're actually dealing with the market's reaction to the original pricing strategy, and that is a seller risk. And to be clear, aspirational pricing can work in certain cases. Take a look at Fox Hill in the Country Club, for example. La Jolla's first gated community in over 40 years, currently in development. The reason the original estate, which sits on just over 30 acres, was able to trade for $35 million back in 2024 is because the listing agents who took over, they actually did not treat this property as a traditional deal. They applied an entirely new concept, a new value proposition, creative development strategy. Because the parties who were involved in the transaction, they took advantage of the acreage and they split it up into separate lots. So that's way different than just taking a property that, let's say, sits on a quarter acre and saying that you'll do aspirational pricing on that, because where's the new value proposition then? So anyways, the goal is not to underprice your property. The goal is to help you get the most amount for your house without having it sit on market for too long, where the market rejects it so strongly that you may end up paying the price down the line, which I would hate to see that. So anyways, it may benefit the agent's marketing to tell you a high price to win your listing so that they can have it as part of their collection on a shelf to appear more dominant in the market. But does it really benefit your bottom line? Does it really benefit the sale of your home? You have to think about that. So anyways, you can use this chart here just as a guide if you'd like. And if I was a seller within this range with a house that is worth somewhere from $9 to $11 million, I would let my property sit on market for at least 2.5 to 4 months before I even considered a reduction. Let it sit, let it breathe a little. It takes time. It takes more time for the higher end than the lower end. So anyways, thanks again for watching. I'm Tara Ravenbach, your La Jolla Native Insider. Thanks and have a great night.